The funding doesn't always need to be property backed. We got to show them that you can afford the loan the way they look at it. We did provide a forecast to show the bank what they're going to do with the business.
Give us a bit of a rundown on how banks look at lending for business acquisition and sort of the metrics that they consider when someone goes down that path.
Yeah, for sure. So there's a few things the bank are going to want to look at. The first one for me is the people buying the business. This one I would say is going to be the most important. They want to know that the people buying this business, they've got experience within this field. Preferably, they've been in the industry, they've already been working there, and their skills are transferable. The next part is a statement of position of the clients, what they've got behind them. The funding doesn't always need to be property backed. So I just want to make that clear. It's preferable. The bank obviously would like it to be property backed. If the client's got a really strong statement of position though, so assets versus liabilities, and the business itself has a decent balance sheet, there's actual tangible assets there, we could look at a form of lending called unsecured lending. The other one is servicing. So we've got to be able to show the bank that you can repay the loan on the policies and metrics that they use. The real world rate that you might get on your loan, let's just call it 6.5% to 7.5% on a business loan, typically on a secured business loan, okay? The bank aren't assessing it at that rate. They're actually adding a buffer to that. It's a considerable buffer too. And so they might be adding a 3 to 4% buffer on top of that. So that's what I mean by we got to show them that you can afford the loan the way they look at it. That's generally speaking how we go about putting lending in place for a business acquisition loan. Recently, there was a client who was selling their business, which did concrete polishing. They've been in the industry for quite some time. 2 of the employees were approached to purchase the business. They've already been working in the business for some time, and these boys wanted to take it to the next level. How I presented that to the bank, here are 2 employees who've been working there already for some time. They want to take over the business. Here are their positions. Here are the historical financials of that business, which showed that even on the historical financials, they can afford it. But also, the boys are planning to do some things differently. So here is a forecast, because this went from 1 owner running the business to 2, which meant that they could run additional teams to complete concrete polishing, and anticipated uptick in revenue, which resulted in an uptick in the bottom line, in the net profit. So we showed the bank that as well, but I actually told the bank, hey, it actually just works on historical performance without no uptick. The boys had already been working in this business. The 2 people who bought it, their assets versus liabilities position was fairly decent. They were younger, so they've still got time to build. It's serviced on historical data, but we did provide a forecast to show the bank what they're going to do with the business. The boys now have been running it for the past 2 or 3 months now, and they're doing exactly what they said they were going to do. They're running 2 crews, they're smashing out jobs, and they're doing really well. I'm really excited to see where those boys are in 12 months' time.